Today, we will talk about how to start investing in crypto with $100, a beginner's guide. Cryptocurrency has become a buzzword in the world of investments, drawing attention from seasoned investors and curious newcomers alike. With its promise of high returns and the opportunity to participate in a revolutionary financial system, crypto investing can be enticing, even if you only have $100 to spare. This video will help beginners navigate the basics of investing in cryptocurrency, focusing on how to get started with a modest initial investment. 1. Understand cryptocurrency basics. Before diving in, familiarize yourself with the fundamentals of cryptocurrency. Cryptocurrencies like Bitcoin (BTC) and Ethereum (ETH) operate on blockchain technology, which is a decentralized ledger that ensures secure and transparent transactions. Each cryptocurrency has unique features and use cases, so research the most popular ones to determine which aligns with your goals. It's also crucial to understand terms like wallets, exchanges, and market volatility. Knowing the risks and potential rewards of cryptocurrency investment is key to making informed decisions. 2. Choose a reliable crypto exchange. To start investing, you'll need to select a cryptocurrency exchange where you can buy and sell digital assets. Popular platforms like Coinbase, Binance, and Kraken offer user-friendly interfaces and are ideal for beginners. When choosing an exchange, consider factors such as fees, security measures, and the variety of cryptocurrencies available. Once you've chosen an exchange, create an account, verify your identity if required, and link your payment method. Many platforms accept bank transfers, credit cards, and even PayPal for deposits. 3. Diversify your investment. With $100 to invest, it's wise to diversify your portfolio instead of putting all your money into one cryptocurrency. Allocate your funds across several coins, such as Bitcoin, Ethereum, and other promising altcoins like Cardano, ADA, or Solana Sol. Diversification helps minimize risks since the value of different cryptocurrencies doesn't always move in sync. For beginners, allocating a larger portion, 50 to 60%, of your investment to established coins like Bitcoin and Ethereum is a safer approach, while reserving the rest for smaller, high-growth potential coins. 4. Set up a secure wallet. After purchasing your cryptocurrencies, you'll need a secure place to store them. While many exchanges offer built-in wallets, transferring your assets to a personal crypto wallet provides additional security. There are two main types of wallets. Hot wallets, connected to the internet. These are convenient for frequent transactions, but are more vulnerable to hacks. Examples include Trust Wallet and MetaMask. Cold wallets, offline wallets like hardware devices, Egg, Ledger, or Trezor, provide maximum security and are ideal for long-term storage. Decide which type of wallet suits your needs based on how often you plan to trade. 5. Start small and use dollar-cost averaging (DCA). With $100, consider adopting the dollar-cost averaging strategy. DCA involves investing small fixed amounts regularly, rather than putting all your money in at once. For instance, you could invest $20 per week over 5 weeks. This strategy helps mitigate the impact of market volatility and ensures you're not buying at a peak price. By spreading your investment over time, you'll average out the cost of your purchases, potentially reducing your risk. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.